Dear ladies and gentlemen, dear colleagues from the bank, good morning and welcome at the Bank of Slovenia. Also, a warm welcome to all of those who are following us over the video link. It's my great pleasure that I can introduce today my dear colleague Madis Müller from the Estonian Central Bank. He will be talking about inflation, and no need for additional explanation why this is the topic of his today's lecture. I think that we also managed to obtain a good timing for this event, namely from the European perspective. Just yesterday, we received new figures for inflation in Euro area, and they are not very encouraging numbers. And from our national perspective, yesterday, the first update of this year forecast for Slovenia was published by National Institute of Economic Analysis. More precisely, Madis will be talking about the drivers behind high inflation and why there are such big differences between different members of Euro area in terms of inflation rate. Namely, according to the latest data published yesterday, the lowest inflation in February on a yearly basis was recorded in Luxembourg. It was 4.8%, and the highest was recorded in Latvia with just about 20%, whilst the average for the Euro area was 8.5%. Estonia here on the upper side with 17.8%, and Slovenia slightly above average with 9.4%. And these differences between different countries are all-time high inflation differentials with the Euro area. Needless to say, these are numbers which are very worrisome for general public, for households, for enterprises, and also for sovereigns. Let me quote just one figure, and that is according to the latest Eurobarometer survey, more than 90% of Europeans are seeing high inflation, high rise of prices as the most pressing issue at the moment. And of course, this is also a highly topical issue for us central bankers, since we are at the end of the day responsible for price stability. And that's basically why we already reacted to these high figures in inflation last year. And let me just remind you that less than a year ago, we were still running very accommodative monetary policy. We were in so-called area of unconventional measures. Firstly, interest rates were still negative at minus 0.5 percentage points, and we were still expanding our balance sheets, both under pandemic emergency program, purchasing program, and also under the regular APP program. So then in April last year, we changed course. Firstly, by stopping net purchases under the PEP program, then following 3 months later with ending net purchases under the APP program, and then in July rising our interest rates for the first time, and that is for 0.5 percentage points in order to reach 0%. That was followed by 2 increases of 0.75 percentage points each, followed by additional 2 increases of 0.5 percentage points. So altogether, in less than 8 months, we increased our interest rates by 300 basis points in order to have our main interest rates at 2.5% at the moment. And that's not the end of the process, of course. With very high overall inflation, with very high headline inflation and with core inflation even on the increasing trend, it's our intention to raise interest rates even further. Here, my personal expectations are that the increase we intend for our March meeting, that is 0.5 percentage points, will not be the last one. We will have to continue with increases of our interest rates in the following months in order to reach the levels that we will be comfortable enough that inflation will return to the trajectory towards 2%, which is our midterm goal. And also, in addition to interest rate increases, we will also continue reducing the size of our balance sheet. We just started at the beginning of this month of reducing of first step of reduction at the level of 15 billion euro. And my expectation is that we will continue or even increase the speed, the pace of deterioration of our balance sheet before our summer break. So I strongly believe that our determination, that our determined action will contribute to lowering of inflation in the next months, in the next quarters. But as Madis will explain in his lecture, the differences in inflation between member states are caused by other policies as well. There is fiscal policy with a very important contribution, which is still under the domain of national governments. There are, of course, different wage policies across euro area member states and many different structural policies, which are all contributing towards high inflation at the moment. So, in order to bring inflation down, it's not enough just to react with monetary policy, but the overall policy mix, monetary policy, fiscal policy, including wages and structural policies, must all be directed into the same direction, that is towards the lowering of inflation. So I will stop there and give my dear colleague and friend Madis the word. So Madis, the floor is yours.
Thank you very much, first, Boštjan, for the invitation. Ladies and gentlemen, it really is a pleasure to be here. It has so happened that in the last couple of years, I have already twice had the pleasure of visiting Ljubljana. Both were such excellent trips that it didn't take me too long to think when Boštjan invited me to give this lecture today. Knowing what good hosts you are, so I know it's going to be another very pleasant trip. But today, my plan is then to take stock of where we stand in our fight against the common enemy of inflation. I will first talk briefly about the causes behind the surge of inflation, both globally and in Europe, where we should also note, and as Boštjan explained, that the current inflation rates differ indeed widely across member states of the euro area. And I'm also in the unenviable position of coming from a member state with one of the highest inflation rates in the euro area last year, which is why I will also explain what's happening in Estonia and what are the particular reasons behind the fast growth in consumer prices that we have experienced. I will then explain how high inflation impacts consumers and public finances, how monetary policy has responded, and also how monetary, fiscal, and structural policies interact. And then my plan is to conclude by explaining indeed why the best contribution that we as central bankers can make to the economy is to restore price stability. And this requires us to maintain our course of monetary tightening until we are confident that inflation will be brought back to its target in a lasting and sustainable manner. Now, Boštjan already gave, I think, a pretty good overview of the monetary policy decisions that we have taken and what is likely to still lie ahead us. but since you have given me a little bit more time, so I can perhaps go into a bit more detail. So I also have a few slides as background for my lecture. So the search for the causes of the current high inflation starts in the aftermath of the COVID-19 pandemic. The global economy recovered fast once the pandemic ended and restrictions on consumption and travel were lifted. Aggregate demand in our economies bounced back, and it was also supported by wide-ranging support measures that governments and central banks offered to help companies and households cope with the crisis. Then it turned out that not all companies could respond quickly enough to this increase in demand, as some restrictions lingered and supply chains remained fractured. And this put pressure on input prices that was then passed on to consumers. Then Russia attacked Ukraine, and this caused energy and commodity prices, including food prices, to increase sharply. The energy crisis hit Europe especially hard, as the European Union as a whole and many member states were heavily dependent on Russian oil and gas. And Russia weaponizing energy pushed inflation up to levels not seen since the great oil shock in the 1970s and the 80s. By October last year, inflation in the euro area had passed 10%, and though inflation rates were very different across member states, ranging from 7% in France to about 20% in the Baltics in that month. Then inflation in Slovenia at that point was just below the euro area average of around 10%. The differences between inflation rates in various countries of the euro area first started to widen already in 2020, when the pandemic caused stronger disinflation in countries that have larger tourism sectors and were thereby hit harder by the COVID pandemic. As the pandemic faded, inflation picked up most in countries where the economy had declined less and where labor shortages were starting to put more pressure on wages. The Baltics were hit even harder by supply chain disruptions when the war and sanctions cut off imports from Russia and prices rose. Before the war started, gas and electricity were relatively cheaper in the Baltics than they were on average in the euro area. And this relatively low starting point made the subsequent price increases also larger in percentage terms. After Russia invaded Ukraine, energy became the biggest cause of divergence between the headline rates of inflation in the euro area countries. A range of factors have caused this divergence, including the extent to which energy prices were regulated, what kind of support measures the governments chose to alleviate the energy price shock for households and companies. Differences in the energy generation mix have also contributed to the divergence, as have terms of household utilities contracts. In countries where electricity or gas prices are fixed for longer, it also took longer for the increase in prices to pass on to consumers. So let me now summarize the main reasons why inflation was particularly high in Estonia, reaching close to 20% last year. And much of the following really applies also to Latvia and Lithuania as the other two Baltic countries. To start with, the share of energy and food in the consumer basket is still somewhat higher in our countries than is the average for the euro area. This meant that rapid price rises for energy and food in particular consequently had a bigger impact on our inflation readings. Compounding this, price setting has traditionally been more flexible in the Baltic region than in other euro area countries, meaning that both rises and also falls in commodity prices are translated more swiftly to consumer prices. Administered prices are also flexible, and governments have allowed higher global energy prices to pass through quickly to regulated prices, while governments in some other euro area countries have been more cautious. High energy prices in Estonia have passed through to consumers also particularly fast because our households have generally preferred to have flexible prices in their utility contracts. This had been a smart choice in most previous years, but it cost us indeed dearly in 2022. It meant that any price increases in the wholesale markets for electricity were, electricity in particular, but also for gas, were immediately reflected in the prices paid by households. And the increases in the prices of electricity that Estonian households experienced in the first half of last year indeed were dramatic. A third and more general reason why inflation has been high in the Baltic countries was the fact that the economic impact of the pandemic was more limited in our region. And the pandemic was also followed by a very strong and swift recovery. Expansionary fiscal and monetary policies combined with strong domestic demand pressures therefore also contributed to an increase in inflation. On top of this, in our case, there was a change in the Estonian pension system in the autumn of 2021 that allowed individuals to start withdrawing their pension savings before they reached retirement age. Some of this money was used to fund private consumption, which then further fueled the demand and increased inflationary pressures. The substantial dispersion of inflation rates between the countries of the euro area poses the question of how harmful such differences are in a monetary union. Obviously, there will always be differences between the structures of our economies, so there will always be some differences between the inflation rates in different countries. Such differences have been around since the euro was first introduced, though for most of the time they have so far been minor. Large differences in inflation rates could, however, lead to problems with the smooth functioning of a common currency area. An obvious problem is that a common monetary policy allowing nominal interest rates to be similar in all of the euro area countries will lead to differences in real interest rates if there are differences in inflation. The real interest rates in countries with higher inflation might be too low, while the real rates may be too high for countries with low inflation. The common monetary policy then becomes too lax for some countries, and it might at the same time be too tight for others. There may also be possible concerns about the price competitiveness of individual countries in a monetary union if they experience persistently higher inflation at the country level. And finally, not every country in a monetary union will have identical economic and financial cycles, and this can then in turn again cause differences between national inflation rates. These are, of course, all well-known challenges faced by monetary unions, and the solution can only lie in prudent use of other economic policies by the government, that is the structural and also fiscal policies. When we talk about inflation, we usually mean how prices change for the average consumer. However, the actual impact that inflation has on individual households can vary quite a lot depending on their consumption patterns and the dynamics of the prices in different goods and services. Households that spend a larger proportion of their money on food are more exposed to changes in the prices of food, while households that have a higher spending on housing feel inflation bite harder, for example, when prices of energy rise. Studies show that households on lower incomes are generally more exposed to the problems caused by high inflation than those with higher incomes. The difference between the levels of inflation experienced by different groups in society was not that large when inflation levels were low, amounting to about 1/4 of a percentage point as shown by the research done at the ECB. The gap between the inflation rates for households on higher and lower incomes had widened in the euro area to 1.9 percentage points by September 2022. And calculations for January 2023 by the Bruegel think tank indicate that it had reached 2 or 3 percentage points in many European countries, and as much as 5 or even 7 in countries where inflation was 20%. Such differences can aggravate inequality and have substantial distributional effects. It is the low-income households that face higher rates of inflation, but they typically also have smaller financial buffers and hold their savings on bank accounts with lower interest rates, which are less protected against inflation. And this makes it indeed vital that governments target their support measures as accurately and as possible and really try to reach the people most in need. High inflation also affects the public finances, as the relationship works through numerous channels in both directions. Some of those channels are direct consequences of policy measures to alleviate the impact of high inflation, especially higher energy prices. Again, referring to estimates of the Bruegel think tank, countries in the European Union allocated a total of 657 billion euros to cutting energy taxes and supporting households and firms between September 2021 and January this year. This amounts to 4.5% of GDP for 2021, a sizable amount of extraordinary spending indeed. And some countries have raised additional revenues to cover this by introducing windfall taxes, for example, on energy companies. One positive side effect of higher inflation is that it reduces the ratio of government debt to GDP, because just the nominal GDP grows that fast. This good news, however, will be offset by and has been offset also now by the sharp rise in interest rates over the past year. The most likely net effect is that interest payments on government debt will be higher for the years to come. Inflation affects the fiscal balance through both revenues and spending, and there are both positive and negative effects. Higher inflation may bring in more tax revenues relative to GDP if, for example, the brackets in the income tax system are left unchanged, but then again, less revenue relative to GDP for excise taxes that are fixed in nominal terms. Spending may decline in relation to GDP if pensions and public sector wages adjust slowly, while discretionary support measures of the type we have seen applied in the EU countries over the past year, of course, increase public spending. It is worth noting how high inflation can affect public finances in surprising and also perhaps contradictory ways. During the first year of rising prices, the budget balance, in fact, very often improves. The higher prices first make the tax base larger, and there are higher revenues from consumption taxes, while at the same time there can be a long lag before many costs adjust. This means that there is a so-called fiscal honeymoon in the first year of higher prices that creates the illusion for policymakers that there is additional room in the budget to spend. And it is only in the next year or two, as costs adjust and indexation mechanisms start to work, that the painful reckoning often comes due. The caution is therefore needed when any additional fiscal support measures are designed. Ongoing research at the Bank of Estonia has attempted to estimate the extent to which an unexpected rise in inflation would affect fiscal balances in the euro area using data from the mid-1990s to 2021, and has found that inflation has a sizable positive effect on the fiscal balances as a percentage of GDP. The positive effect comes both from the expenditure side of the budget and from the revenue side. This is particularly true when there is a significant positive inflation surprise, meaning that when actual inflation turns out to be higher than expected. Governments in Europe increased their spending in 2022 so they could fund energy subsidies, invest in their defense forces, and provide the help needed by Ukraine. Despite this extra spending, though, the fiscal picture has remained relatively benign in most countries and also in the euro area as a whole. This also applies to Estonia, where preliminary data suggests that the fiscal deficit for last year will be around 1.2% of GDP. And this benign outcome can, in large part, be ascribed to the high inflation that we saw last year. Looking ahead, this boost to public finances is likely to be reversed when inflation comes down, at which point deficits will creep up again. And this is something I think that politicians should keep in mind as they plan the government spending and the taxes for the years ahead. But now let me come back to monetary policy that Boštjan already started explaining in terms of what we have decided and what's likely still to be decided. Indeed, times are challenging for central banks. It is difficult for monetary policy to address supply-side shocks that are both inflationary and recessionary at the same time. If such shocks do not last for long, it might be appropriate to wait and see whether inflationary pressures will recede by themselves without any additional strain being put on the economy by higher interest rates. But this was not the case this time, however, and central banks were not able to just wait and let inflation spread through the economy. Because once the inflationary mindset has taken hold, it is very difficult to change. Businesses and consumers must have confidence that central banks are determined to bring inflation down to its target, even if it cannot be achieved overnight. Before I discuss the latest monetary policy decisions of the Governing Council of the ECB, let me also take a brief detour into the not so distant history. Late in the autumn of 2021, we were quite confident in the Governing Council that most of the supply-side inflation pressures caused by the pandemic would fade by the coming spring. We expected that economies reopening after the COVID restrictions and historically low unemployment would together restore healthy demand, and so it seemed reasonable to start scaling back monetary policy support, while at the same time still keeping an eye on the lingering uncertainties hanging over from the pandemic. We decided that the pandemic emergency purchase program through which the central bank provided support to the economy would end by March 2022. We also decided that any additional net purchases of securities by the central bank would be scaled down gradually over the year. These expectations, however, were confounded as the strict pandemic restrictions that China applied in winter 21 and 22, and then Russia's invasion of Ukraine created new turmoil. The economy held up better than was at first feared, but inflation turned out to be much higher and more persistent than we expected. Inflation forecasts have time and again climbed higher, and by June there was no doubt that it was high time to speed up the normalization of monetary policy. So we ended net asset purchases and started to raise interest rates in July. When we started to sketch out the policy normalization, the financial markets did not expect policy rates in the euro area to rise at all until 2024. Instead, we have now had to raise interest rates in the euro area faster than ever before in the history of the monetary union by 3 percentage points in just 6 months. This may seem dramatic, but we must also remember where we started. Interest rates had been very low for more than a decade, and in fact they still are lower than they were before the global financial crisis. The ECB has not been alone in how it has acted. Some central banks started to normalize the monetary policy even earlier, and the exit from the highly accommodative monetary policy has been swifter than was expected. Headline inflation started to come down towards the end of last year, mainly thanks to the decline in energy prices. It fell to 8.5% in January. But more worrying, however, is that core inflation has remained persistently high at more than 5%, as the underlying price pressures are not yet receding. The Governing Council consequently announced last month that it will continue to raise interest rates and keep them high enough to bring down inflation back to the target of 2% in the medium term. We also indicated that we intend to raise interest rates by another 50 basis points at our next policy meeting in March. And it is most likely that this will not be the last rate rise in this cycle. And it is also quite possible that interest rates will need to stay high for quite some time so that we can be sure that inflation will come back to and remain at close to 2%. Central banks need to focus on second round effects from inflation and prevent large but temporary price surges like those we have seen in very volatile energy and food prices passing through into other prices, labor costs and inflation expectations. If they do, they could cause a wage price spiral which would then stop inflation from falling back to its medium-term target level and also after the temporary shocks have faded. High inflation is clearly a challenge not only for people, companies and central banks, but also for governments. Europe has recently witnessed significant turmoil in energy markets, and governments have tried to find ways to provide relief to households and companies either by direct subsidies or through new regulations in the energy markets. But even before the Russian invasion of Ukraine, it was expected that the green transition would push energy prices up. The signal given by that rise in energy prices was intended to have an important role in encouraging the green transition. The problem now is that not only are energy prices being steered by the green transition, but of course they have also moved much more sharply because of the extreme tension in geopolitics. We should, however, distinguish between two features of the current problem when it comes to energy prices. The first is that higher prices have undermined purchasing power, increased inequality, and made energy-intensive industries less competitive. The second is that energy prices have become increasingly volatile, and this in itself is a problem that policymakers need to tackle. That the price of electricity for consumers can range between -1 cent and 400 cents per kilowatt hour, that as we have experienced in Estonia, for example, it is a concern also from the perspective of price stability. Governments are therefore facing important choices when deciding appropriate policies for the energy sector. Looking beyond monetary policy, fiscal policy can have both a direct and indirect impact on inflation. As I mentioned earlier, one of the reasons why inflation rates vary so widely between the countries of the euro area is that countries may at any moment be at somewhat different points of the economic cycle. The Baltic countries, for instance, felt a more limited impact from COVID-19, and our subsequent recovery was quite strong. And the strong cyclical position of the Baltic countries was also one of the key causes of the acceleration in inflation. As common monetary policy cannot solve cross-country differences in cyclical positions, fiscal policy must play a role. In countries where strong domestic demand is causing high inflation, a tighter fiscal policy can help reduce the pressure. Governments also use price controls and subsidies for energy prices directly to keep prices under control, but do so in different ways. Price controls are usually applied when market mechanisms fail. If prices are high because markets are malfunctioning, then price controls allow the authorities to buy time to fix the mechanisms that set market prices. But price controls cannot solve the issue of scarcity, which is often the main cause of high prices. The main disadvantage of capping prices is that price ceilings do not guide consumers to reduce their consumption of the scarce product. This has been the problem with price caps for energy, as it does not encourage consumers to use energy more efficiently, and nor do caps offer producers any incentives to increase supply. The alternative is targeted income support measures, which allow the burden of higher energy costs to be shared within the society. Unlike price controls, these measures preserve price signals and help to steer both demand and supply towards a new equilibrium. The main concern with income support is that it is, of course, much more difficult to manage. How target groups are selected is a highly political issue, and any such measures are an additional fiscal cost, so they need to be also temporary and well targeted. So let me summarize. Headline inflation is falling in the euro area, but it still remains far above the ECB's target of 2%. That measures of underlying inflation are very high is even more worrisome, as it indicates the presence of more persistent inflationary forces that can be more difficult to break. The differences in inflation rates between the member states of the euro area have largely been driven by energy prices and the policy measures taken by governments, and those divergences remain wide. This may become a problem for the euro area if such differences become persistent and hamper the transmission of monetary policy and the smooth functioning of the currency union. The ECB, of course, can only make monetary policy for the euro area as a whole, without tailoring it to the needs of any particular country. And this makes it vital that such divergences in national inflation and real interest rates are kept in check by national structural and fiscal policies. Government support measures that are taken to shield the economy from the impact of high and volatile energy prices must be temporary and well targeted, so that they preserve the right incentives for consumers and energy producers and do not overburden government finances. In setting monetary policy, central banks must not hesitate to fight high and persistent inflation. Keeping prices stable is the best contribution that we can make to the economy, and doing so is essential if we want to see the purchasing power recover and businesses regain confidence to invest and create jobs. If we hesitate, we may later have to raise interest rates much higher and keep them high for much longer in order to get inflation down to the target of 2% and also keep it there. So with this, I will conclude. I thank you for your attention, and I'm happy to answer any questions that you might have.
Thank you, Mr. Müller, for this interesting lecture. If there is any questions, please raise your hands. We will give a microphone to you. Introduce yourself and please say a question in English. Any questions?
Hvala lepa. Thank you very much, Madis, for this very interesting lecture. Talking about the heterogeneities across the countries, what is your view on the transmission mechanism divergences and heterogeneity in the financial markets, and then response of the macroprudential policies? Maybe if you can say a couple of words on that, because we see differences now. Some countries have fixed, flexible interest rates. We see countries have different credit development, and for sure that also had contributed to differences in inflation rates, I guess. Thank you.
Yes, thank you, Tina, for the good question. It is true that the transmission of monetary policy decisions is also different by country. And speaking of my own country, this is very much now on the minds of people because the transmission is particularly fast, since basically all loan contracts use the 6-month Euribor as the reference rate, which means that mortgage rates and lending rates for corporates have indeed increased very sharply. So perhaps it indeed for countries that such as the Baltics, where I first explained that the prices are more flexible generally than in some bigger markets, and it, in a way, it also sort of amplifies the cycle also through interest rate changes. But then again, on the on the flip side of the coin, when we look at the history, then thanks to the floating mortgage rates, we have, for the previous number of years, 10 years or so, actually enjoyed lower mortgage rates than the euro area average. So there are always two sides of the coin, but you're right that also the transmission might work differently in different countries depending on how the financial system is set up and what are the market practices in any country.
If I may follow up a little bit on this, I was actually quite surprised that all the components of inflation were higher in the Baltics, because energy and food, I was expecting it. And of course, given what you were saying about the transfer mechanisms and that the state didn't decide to regulate things, I did understand that, okay, services, but industrial goods as well? I mean, you're a small open economy, just the same as Slovenia, strongly related to imports, exports. So how come this happened in industrial goods as well?
That's a good question. I think it indeed is the most difficult to explain for industrial goods. For services, perhaps the strong domestic demand and the relatively good shape of the economy can explain the price pressures better. But also, given that now I'm speaking of Estonia, although again, I guess it applies for Latvia and Lithuania as well, the fact that our economy was, at least until the mid of last year, still in a relatively good shape, even if prices were increasing quickly. If you look at the statistics, the purchasing power of people was falling, but everyone was still spending basically the same manner that they had before. It's just paying more for the same goods and services. So the demand also for industrial goods in a relatively small market, where perhaps the level of competition is still not quite the same as in some other markets, I guess it allowed also companies, the merchants, to not have too many discounts on industrial goods, I suppose. But generally speaking, the fact that we have indeed relatively strong domestic demand, and also that some of the government policies fueled it even further, I think made the situation somewhat worse. And so it was not only about food and energy that were the biggest contributors. By now, energy prices are falling. In our case, perhaps we will see it also sooner in the inflation readings than some other countries because of the flexible nature of prices. But then again, food prices are now the ones contributing most to inflation at the moment.
Any more questions? Yes, in the back.
Hi, I'm Matthew, teacher at the European School. I asked my students to ask a question, but none of them seemed brave enough, so it will be their teacher. You mentioned a couple of things. One, that the inflation tends to have an impact on lower income households predominantly, or more than higher income households, and the need for managing inflationary expectations. So you described some measures in monetary policy that the central bank has taken, but what about inflationary expectations and wage cycles and wage growth and these sorts of elements? What is the bank's position on this?
You're asking about our experience in Estonia, or more generally?
More generally, I think.
Okay. So when it comes to wages or wage pressures, then well, I think it's quite natural also now that inflation has been so high that people and the loss of purchasing power has been significant. That there's an expectation that wages will increase, and some of this loss in purchasing power could be compensated through that. We have also seen it in the euro area as in terms of the averages, that wage growth is picking up. We have seen it, speaking of Estonia, we have seen it very clearly in our case. The wage growth is between 8, it has been around 8-9%, probably will stay relatively strong also this year and perhaps the next. But then of course we need to make sure that in the long term the growth in wages goes hand in hand with the growth in productivity, and also on the country level, if the wage growth is too fast and the input costs for companies therefore are very sharp, at the end it means that the country and its exporters will lose the competitiveness, and at the end the day of reckoning will be harder, and eventually this is not favorable to the sustainable growth in the well-being of the people. So I think we need to make sure that we don't end up in such a price wage growth spiral. I don't see that really happening right now. Also, as inflation expectations, they really are close to 2% still in the long term. But with our actions as central bankers, we also have to make sure that it stays that way, and there is the confidence in the general public and financial markets that we can bring inflation levels down.
Okay, thank
so
you.
now to the students. Huh?
Okay, there was another question from the third row. No, it's okay. Okay, any more questions? Yes, please.
Hello, Robert is my name, Banka Slovenije. You mentioned before taxes on windfall profits targeting energy companies. I wonder if you have that in Estonia, and if there was at least any discussion regarding this, and if you could maybe summarize this discussion. Thank you.
We did not have a windfall profit tax for energy companies, but what did happen in our case, and I didn't get into that much detail with the way that the government has tried to help Estonian people with the high energy prices. But what they did is that since we have a big state-owned energy firm that is the main producer of energy and also directly sells to the consumers, then basically the government, after those wild fluctuations in the energy prices, mandated the state-owned firm to provide a fixed and relatively favorable electricity price to households, which basically was at the cost of this energy firm's profits. So in a way, you could say that indirectly, the government went after the profits of the state-owned firm that otherwise would have been much larger even, and then provided this more favorable electricity price package to households. Meanwhile, the wholesale market prices of electricity have come down to the extent that this is not anymore that favorable to people, and households are switching back to market price contracts. But this is a way that indirectly the Estonian government handled it.
In the back.
Thank you very much, Mr. Müller, for your speech. My name is Lukianos Klint. I'm from the Greek Embassy here in Slovenia. I'm the commercial attaché in charge of economic and commercial affairs. I would like to ask whether what is your feeling, the bank's feeling, regarding the relevant importance of the real economy? Because I believe you mentioned that there are structural reforms, etc. But if a country does not diversify away from the main sources of inflation like Russian gas, and if we don't find other solutions for energy procurement to our economies, do you feel this is more important than the inflation, than managing the interest rate? I mean, which one do you think is most important, the interest rate or the real economy and diversification away from one single source of gas supply?
Well, obviously, diversifying the European energy purchases away from Russian oil and gas, that is absolutely important. It has also taken place and is taking place to to a large extent. So I think it's difficult for me to weigh which one is more important. Both are, of course, important. It's just that as central bankers, we deal with interest rates and inflation. At the end, both have an impact on real economy. So as I mentioned also, everything that has to do with energy markets and supply of energy, absolutely, it's a critical question for European governments.
Okay, there was one more question. Front row.
Hi. You said that a large portion of loans are linked to Euribor in your country. And I was wondering how quickly have or will, under your assumption, banks adjust to deposit interest rates, and how this might, in a way, boost the purchasing power of households.
Well, that is a big debate, to be honest, in Estonia right now. I'm not sure about the lending practices in Slovenia, but looking at, and how different it might be in your case, but looking at the banking sector in our case, then since loans are basically all linked to Euribor rates, the interest income is very quickly growing. Whereas in the last 5+ years, since deposit rates have been so low also for time deposits, pretty much everyone has been holding their savings just on the current demand deposits that pay no interest, and people are quite slow to shift to time deposits, which means that funding costs are not growing as fast, and the profitability of banks is of course going up. We have seen, well, there's a public discussion if that is reasonable, and speaking of windfall taxes, maybe we should tax banks instead. But what we're seeing already is that indeed the deposit rates are also going up, particularly for smaller banks that have more of an incentive to also fight for additional deposits. It's also the nature of the Estonian banking market that it's quite concentrated among a few large banks that for the time being they have plenty of deposits and they have no financial incentive really to increase interest rates on deposits much. But nevertheless, given also I think partly because of the public pressure, we have seen the deposit rates on term deposits now pick up. I think they must be among the highest in the euro area. So you can get 2.5, 2.6% on a 1-year deposit. And it has, just in the last month, it has picked up. Also, as a central bank, we have said that additional taxes on banks are not a good idea if the overall goal is to have as favorable as possible lending rates and deposit rates for Estonian households and corporates. Because if you just put another cost on banks, then this is not moving in the direction of more favorable banking services, in terms of the banking services. But indeed, we should just make sure that the competition is there to first of all, make banks to increase the deposit rates, but also I think there's room to lower the margins that we have seen so far on mortgages or perhaps also corporate loans.
Okay, if there are no more questions, we can conclude the event. Thank you, Mr. Müller.
Thank you very much once again.
S tem smo torej prišli do konca današnjega dogodka. Najprej še enkrat iskrena zahvala Madisu za zelo zanimivo predavanje in seveda dodatna pojasnila. Hvala vsem vam za udeležbo, še posebej tistim, ki ste aktivno sodelovali tudi z vprašanji. Naj na koncu samo namignem, da je bil to seveda samo eden izmed dogodkov, eno izmed gostovanj guvernerjev drugih centralnih bank v Banki Slovenije. Naslednji dogodek, ki ga načrtujemo v kratkem, bo namenjen vprašanjem povezanimi s širitvijo evrskega območja. torej z izkušnjami Slovenije, z izkušnjami zadnjih članic na tem področju, tako da dovolite, da vas že danes vljudno povabim tudi na naše naslednje druženje. Hvala lepa še enkrat in prijeten dan še naprej.